As you can see, we have a lot to cover, so I'm going to quickly outline everything we'll go over tonight. We will begin with a review on the objectives of this presentation, and then we'll move into the definition of conditional sales tax and why it is important or relevant to our work. We will then take a look at a few scenarios where we will see conditional sales tax agreements used in business, and I will also underscore the benefits and challenges of conditional sales tax. So we'll actually spend some time reviewing the benefits and challenges to both parties of a conditional sales tax agreement. So that's the buyer and the seller. And then we'll also look at the benefits of using conditional sales tax over some other financial methods, such as a loan. We will then review what the business purpose is, where conditional sales tax fits in the overall process, who our typical users are going to be, and then we'll also review SOX compliance. I'll then go over the setups and prereqs of conditional sales tax in D365. And then, of course, last but not least, we'll have a quick demo. Are there any questions with the agenda? Apologies in advance, I'm going to be saying the term conditional sales tax quite a bit in this presentation. After this presentation, you should be able to define conditional sales tax and identify it in business use cases. You also should be able to understand the business purpose of conditional sales tax agreements. One of the most important aspects of this presentation I want you to understand are the setups and the functionality of conditional sales tax in D365. So conditional sales tax is used by many businesses, and it's actually a legal requirement in some countries or regions. So it's important to understand the setups and functionality of it, not only in D365, but in other ERPs as well to assist our clients. Keep these points in mind, and you will likely see questions about them on the quiz later. Okay, so let's move into the definition of conditional sales tax. Conditional sales tax is a type of sales tax that is paid proportionally to the actual amount paid on an invoice, rather than being paid at the time of invoicing. It is paid to the sales tax authority when the payment is posted, not when the invoice is posted. So that's a key element of conditional sales tax. It is paid when the customer pays, not when the invoice is generated. The buyer's payments are going to be dependent on certain conditions being met by sellers. So can anyone think of what some sort of conditions a buyer could expect from a seller in order to enter one of these agreements? Okay, so an example would be quality of goods being sent. The buyer might expect a certain quality. Another good example is discount on bulk orders. The buyer might not enter an agreement with a seller unless they get a discount on bulk orders. So those are just two examples. And then conditional sales tax plays a big role in modern day commerce, and most ERPs can be configured to calculate conditional sales tax on a payment basis. So therefore, it's important for us as consultants to understand it. Okay, and then on the slide are some key elements of conditional sales tax. Typically, an agreement is reached between a buyer and a seller, where the buyer will take possession of goods while the seller retains ownership of goods until the full payment is made. This transfer of ownership is a key element of conditional sales tax, and it is different than most traditional sales transactions where ownership and possession transfer simultaneously between the buyer and the seller. Conditional sales tax agreements are used by almost every modern business. Another key element of conditional sales tax is that it's paid in installment payments, which makes it easier for the buyers to manage their cash flows. And there's also usually an absence of a large upfront down payment, which is, again, nice for buyer cash flows. And then the payment terms, including the amount, the frequency, and the duration of payments, that's all going to be outlined in the agreement. So both the buyer and seller have a mutual understanding of their obligations. Given the transfer of ownership in conditional sales tax agreements that we just discussed, which party, the buyer or the seller, do you think is benefited or protected the most from this? It's a trick. What I'm getting at with this question is security interest. Why would you enter an agreement if either party isn't? What I'm getting at here is security interest. That's another key element of conditional sales tax agreements. With how that transfer of ownership is set up, the seller maintains a security interest in goods being sold until the buyer fulfills all payment obligations. So if the buyer defaults on a payment, the seller does have the right to repossess those goods. And Basically, the seller has a form of collateral in the event that a buyer defaults, so they're at an advantage there. Here on the slide, we have the benefits of conditional sales tax compared between our buyer and our seller. So the benefits to both parties really result from that transfer of ownership that we just discussed and how these agreements are structured. So we'll start with the seller. The first benefit for the seller is one we've already gone over, right? The seller retains that security interest in the goods being sold and has that as a form of collateral if the buyer defaults. Next, the seller typically will negotiate higher price points with buyers. A good example is if a buyer wants a discount on bulk orders, the seller will negotiate with buyer to purchase more units over time instead. We could see that happen. And then lastly, there is a better relationship formed between the buyer and seller, as once these conditional sales tax agreements are formed, there is greater trust and transparency between our buyer and our seller. In terms of the buyer, there are potential tax deductions, and there's also the absence of an initial large payment to receive goods or services. They also experience flexible payment schedules. So in these conditional sales tax agreements, the buyer gets possession of the goods immediately while deferring the full payment and ownership over time. The buyer also has more control over their investment compared to a traditional sales transaction. When traditional sales transactions, the buyer just pays for goods or services up front, regardless of the seller's performance or the final result. But given the setup of conditional sales tax agreements, the buyer has more control by tying in performance metrics. The buyer and seller should have aligned motivations. Are there any questions with that? All right, so we just looked at the benefits between buyer and seller, but let's now compare the benefits of conditional sales tax agreements compared to other financial methods, such as a loan. And I have 3 of them outlined here. We'll look at a loan, a lease, and then a hire agreement. Conditional sales tax allow for a more accessible route to acquire goods without a large upfront financial burden. With a traditional loan, you get that immediate ownership of the goods or the service, but that oftentimes comes with high interest rates. Okay, and then next, the payment installments of conditional sales tax agreements lead to eventual ownership of the goods. Leasing is another financial method that I'm sure we are all familiar with that can be used, which is advantageous to companies who aren't looking to possess long-term ownership of an asset. However, leasing can be costly over time, while conditional sales tax agreements ensure that the payments contribute to eventual ownership of that asset. In summary, conditional sales tax agreements provide a clear path to asset acquisition. The payment terms of conditional sales tax agreements are always clear and flexible. A hire agreement is similar to a conditional sales tax agreement where you have installment payments for deferred ownership, but hire purchase agreements come with higher interest rates, additional fees, and harsher punishments. Conditional sales tax agreements are more flexible and offer more lenient terms. Therefore, they may be the preferred financing method over a hire agreement. We looked at the benefits, so we'll review the challenges too. So one of the main challenges of conditional sales tax agreements is that the seller does risk repossession of goods if the buyer defaults. So let's say we have an agreement where the seller provides an asset, such as a car, and the buyer defaults on that agreement. So the seller does risk not getting that car back. If you ever see someone driving a car with an angry seller racing after them, that might be a conditional sales tax agreement in action. Interest payments can start to pile up. So the buyer may experience a Jenga tower of interest payments piling up on their desk. The buyer also risks losing ownership if they fail to make payments as agreed upon. This is just to outline there are opportunity costs and challenges of any financing method. So buyers and sellers must weigh these challenges and the potential drawbacks before deciding if they should enter one of these conditional sales tax agreements. All right, we'll move on. And then we'll review some examples of conditional sales tax agreements. So on the slide here are the most typical examples of where you will find conditional sales tax agreements be used in business. We'll start with automobiles. So a car dealership will sell vehicles to a buyer under conditional sales tax agreements. right? So the buyer makes monthly payments to the seller who will retain ownership of the car until that full amount is paid. Please do not confuse this with a lease. That's not what I'm talking about here. You can, of course, lease cars, but automobile purchases can also take on the form of a conditional sales tax agreement. Okay. I actually cannot see if anyone's raising their hand right now, but hopefully you know who that is. It is Lightning McQueen from the Cars movie. It relates to the automobile section of this. I will be asking a question in a moment here that'll need audience participation. So the next one's real estate. A buyer may move into a house under a conditional sales tax agreement. The buyer makes monthly payments, and if they default, the seller can reclaim that property. We'll group machinery and equipment and office equipment together. A company can purchase a machine or office equipment such as computers or furniture via conditional sales tax agreements. Okay, so now time for that question. Based on what we reviewed, what do you guys think a key theme here is with what types of items a conditional sales tax agreement is used for? So it's something that you find on the balance sheet, the first section.
Assets.
Thank you. Yes. So key theme here, what all these items on the slide have in common is that conditional sales tax agreements are usually used for some sort of asset purchase. And typically it's going to be some sort of tangible asset or PP&E. All right, so we discussed how conditional sales tax offers buyers flexible purchasing options. What's nice about the functionality in D365 is it will actually all get calculated behind the scenes. So at the time of the sales order and invoice generation, the sales tax will get accrued in what we call a sales tax awaiting settlement account. Once the order is fulfilled and paid by the customer, the tax will be paid to the tax authority as well. The tax is paid when the customer payment is made. The tax will transfer from that settlement account to the payable account at the time of that customer payment. And so conditional sales tax in D365 specifically allows for the booking of actual sales tax liability when that customer payment is made. We will see that happen in the demo behind the scenes. Conditional sales tax also has importance in reporting. There are multiple conditional sales tax reports in D365, and they can be integrated with other modules like the supply chain module. At the end of my demo, I do have a few slides on conditional sales tax reports in D365 and also just general sales tax reports that are offered in D365. I'm not going to actually demo any of them, but I have some screenshots and we will briefly review those reports at the end. It is important because it does relate to SOX. So keep that in mind. All right. So where does it fit in the overall process? We would have these conversations of understanding the client's need for conditional sales tax agreements and begin the general training of conditional sales tax functionality during our training sessions and in our design sessions, right? So that's our installation and training phase and our design phase. And then the development phase is where we would discuss the setups of conditional sales tax. And we would then test this functionality during the validation and testing phase, just to ensure everything's set up correctly and functioning properly. An example of this could be a test case in our CRP scripts to ensure that sales tax is being paid at the time of the customer payment, not at the time of invoicing. A key element of conditional sales tax is that it's paid proportionally to the tax authority at the time of the customer payment, not at the invoice generation like a traditional sales tax transaction. We should have a scenario on our test scripts to make sure that A, the tax is being calculated proportionally, and B, that it's paid at the time of the customer payment. All right, and then what business objectives are solved? Conditional sales tax provides streamlined and enhanced tax management and efficiency. It also easily meets compliance and regulatory requirements. We will review this more in a few slides here, specifically looking at SOX compliance. And then lastly, we have improved financial insights and reporting. And then this one should be pretty easy to answer, but asking from the audience again, who do we think the typical users of a conditional sales tax agreement are? And I'm looking for 3 here. 2 of them are the parties of the agreements that we discussed in a lot of length. we have the buyer and the seller. Let me get it up on the slide here. First, we have tax accountants and tax managers, right? They'll be ensuring sales tax is being calculated, paid, and reported correctly. So they're going to be especially important to ensure SOX compliance is being met. We also have the actual parties of the contract, which are our buyer and our seller. Thank you both. All right. And SOX doesn't actually address conditional sales tax, but we know that SOX requires companies to maintain robust internal controls over financial reporting, and that includes all conditional sales tax agreements. On the slide here, I outlined some key points relating to SOX compliance and conditional sales tax. I do want to leave enough time for the setups and demo, so I'm going to move through this quickly. So we'll start with internal controls. Companies must establish and maintain effective internal controls over their financial reporting. This includes ensuring that all conditional sales agreements are accurately recorded and reported in the financial statements. Next, we have documentation. Detailed documentation of all conditional sales tax agreements is crucial. This includes the terms of the agreement, the payment schedules, and any conditions that must be met for that transfer of ownership to occur between our buyer and our seller. And next, we have audits. Regular audits are required to verify the accuracy of financial statements and the effectiveness of our internal controls. This would include reviewing conditional sales agreements to ensure that they are being properly accounted for. Moving on to management certification. Under SOX, the CEO and the CFO must certify the accuracy of financial reports. This means they must ensure that all transactions, including those involving conditional sales tax, are accurately reflected in the company's financial statements. Last but not least, we have risk management. Companies must assess and manage risks associated with conditional sales agreements. This includes evaluating the creditworthiness of buyers and the potential impact on the financial statements in the event that a buyer defaults. Any questions with that? So really, by adhering to these principles, companies can ensure that their conditional sales agreements are compliant with SOX requirements, and that enhances transparency and reduces the risk of financial misstatements. We'll move on. Before we move into the setups and the demo, I want to quickly review the accounting behind sales tax. I know this is easier for our accounting folks, but for others, I want to go over the journal entry behind sales tax and what's being booked behind the scenes when we're accruing sales tax. The journal entry on the slide sums up sales tax accounting quite well. What we will see in D365 when this is booked. It's important to note this is from the seller's perspective, so make sure to keep that in mind. But we will have a debit to accounts receivable, that's at this top line here. That will be for the full amount of the purchase, including sales tax. And then this bottom line, the sales tax payable account, that's going to be a current liability account, and it will project the amount of tax liability that will be paid to our regulatory authority for invoices billed to the customer. So just to put numbers on here, let's say the sale was for $100 at a tax rate of 10%. So we would see a debit to AR for $110, so the $100 and $10 of tax. Then we would have a credit to sales rev for $100, and our sales tax payable account would amount to that 10% of $100, which is $10. And then we have our debit of $110 equaling our credit of $110 and our journal entry balances. Everything looks good there. I think it's beneficial to understand the accounting behind these agreements. We'll move on with the setups and the prereqs now. So on the next few slides here, I'll be sharing screenshots of the setups in D365, but this slide's just to outline the general process of the setups, which is first defining parameters and setting up tax codes, tax groups, and item sales tax groups. You must set up tax groups in order to use conditional sales tax. So the 3 setups right here, these are not optional if you want to use conditional sales tax in D365. If this was a sales tax agreement with a buyer, We would also have to define any conditions of the agreement using either item groups, customer groups, or location-based conditions. I don't have any of these in my demo because it's not an actual agreement with a buyer and seller, but just note those are more optional setups of conditional sales tax. Okay, we'll move on with the first setup. The very first thing we need to do is enable D365 to account for sales tax at the time of the customer payment. This means we need to turn on conditional sales tax in our environment. To set this up, we navigate to our general ledger, ledger setup, and in general ledger parameters, we'll have a sales tax tab. And this is where you'll find the toggle to enable conditional sales tax in our environment. This is my environment right here, and I do have it turned on. Okay. So we need to define the balance sheet account that we want to use as our temporary sales account. And that will act as the temporary account for the sales tax liability at the time of invoicing. In the screenshots, we can see I have a liability account. It's 2291, the sales tax awaiting settlement account. We'll also want the posting type on that account to be sales tax. Keep in mind, that's our sales tax awaiting settlement account. We're going to see that at the invoice generation, which I will show a voucher. That will make more sense later. All right, so then we're going to want to set up ledger posting groups for conditional sales tax. This is also not an optional setup. You have to set up a ledger posting group in order to use conditional sales tax. So that does have to be defined. And then in my test environment, I set up one for Illinois conditional. So I have this IL_conditional. And I added that settlement account to the sales tax payable field. So from the previous slide, that 2291 account I set up is present right here in the ledger posting group. And before we move on, just note, we also want to make sure settlement periods are set up in D365. And those are found in the tax module under sales tax. You'll find those sales tax settlement periods. I think mine are set up quarterly. So keep that in mind as well as a setup. All right. And next, we'll need to define a dedicated conditional sales tax code, and we'll have to map that code to the ledger posting group from the settlement periods from the previous slide. So that mapping will ensure that upon customer payment, the proportionate tax liability will be transferred from that sales tax awaiting settlement account to the actual sales tax liability account mapped with the reporting sales tax code, which you can see in my screenshot. We have my sales tax code right here, Conditional Illinois. I mapped my settlement period and my ledger posting group to that sales tax code. And that will all be done in the tax module under sales tax. And then there is a tab for sales tax code right up here. Okay, we're almost at the end of setups. Next, we'll create a sales tax group, which is the screenshot on the left of the slide. And then we'll map that group to the sales tax code, which is on the right of the slide. Under tax, indirect taxes, we'll have sales tax and then sales tax groups. I created a sales tax group called conditional_IL and I set that percentage to 10%. So I know it's high, but it was more for the sake of easy math. And so this group I'll put on my sales order line too. We'll see that on the order lines to be able to calculate and accrue the sales tax at 10% for the transaction. All right. And then the last setup is to associate your customer account with the newly created conditional sales tax group. So on our customer record in the invoice and delivery tab, you will find the field that needs to be populated with the sales tax group. So now I'll just review the demo before I pull up my environment, the scenario and what we're going to see. In my demo, we will look at an invoiced sales order voucher. This is where we are going to see that 2291, the sales tax awaiting settlement account, get used, and where we will also see how the sales tax is accrued at the time of invoicing. I'm going to be showing the sales order voucher, so that will make more sense in a minute. And then we will actually enter a partial customer payment and post it. We will see how D365 will calculate the conditional sales tax behind the scenes and hit the ledger. I'm not going to be actually demoing the reports for sales tax agreements, but I will quickly touch on them since they are important to SOX compliance. One of the specific reports we'll be looking at that I do have a screenshot for, it can be found in the tax module under sales tax. And there will be declarations, sales tax again, report sales tax. So it's the report sales tax report, basically. All right. So let me go ahead and pull up my environment. Hopefully you all can see D365. I'm in my environment here. We're first going to look at the sales order that I created. I did already invoice my customer, but we'll look at that voucher real quick. It's going to be this last one. We'll click into it and look at the lines. In theory, we have a customer ordering some sort of asset, maybe like a car, maybe not a car because it is only $100, but some sort of asset that they ordered 3 of. So we know it's $300 in total. I will insert some columns here. Load. Okay. And I'm going to add the sales tax group. Check that one. And the item sales tax group. I scroll over, we can see both of them pulled through. That's because of my setups. The sales tax group, this is what we put on the customer record in the invoice and delivery tab. And then the item sales tax group would be same sort of situation, but just on the item. So those pulled through, and we'll look at the invoice journal. We can see the invoice amount is for $330 because our tax rate's at 10%. So that looks like it calculated correctly. That's what we want to see. The sale for $300 and the accrued tax for $30. And if we look at our voucher, we can see that sales tax awaiting settlement account in use. All right. So we have a debit to accounts receivable for the full $330, right? The sale and the sales tax. And then our product sales is just $300. And here's that sales tax awaiting settlement account for the accrued tax, which is $30. So that looks like it all calculated correctly. That's what we want to see. And then in theory here, we can say maybe our customer is paying in installments of 3, right? It's basically $100 at the end of each month, most likely would be the scenario, including tax. So we'll go ahead and actually record that customer payment. And I'll do that through the customer payment workspace. So I'm going to pick that customer. When I tab, all the invoices should come up. And maybe for the payment reference, we can say like payment 1 of 3. We can select that invoice, this last one here. We can see the full amount's $330. And we know this is 1 installment payment. So the total amount's going to be $110 that they're paying, which is $100 of the sale and $10 of tax. Conditional sales tax is paid proportionally. That all looks good. Let me just select a method of payment. We'll look at the lines and make sure everything looks okay. We can see that we have a payment for $110. It's in balance. We should be good to post this. All right. If we look at our voucher, we're going to see that hitting the bank, right? So we have $110 hitting the bank account and leaving accounts receivable. Where is that conditional sales tax? Like I said, it's calculated behind the scenes. If we go to general ledger and look at our voucher transactions, we will see what's going on. And I'll run it just by today. Okay, so everything up here is what we already reviewed. That was that invoice generation and the $30 of tax hitting that sales tax awaiting settlement account. These bottom 2 are when we actually posted the customer payment. So the $110 hitting the bank. And then we can see these 2 right here. We have $10 leaving our sales tax awaiting settlement account and then hitting the Chicago City tax payable account. That's exactly what we want to see. And it should be $10 because if we did all of our setups correctly, it is paid proportionally, and that would be 10% of $100. So all of that looks good. Were there any questions with that? Let me share my screen. Sorry, 1 second. I know we went over this, but just to reiterate, this was the accrual of that sales tax from the sales order transaction and from the invoice generation. So we have a credit to sales for $300 and a credit to our sales tax waiting settlement account for $30. That's 10% of the $300. So we accrued $30 in sales tax from this transaction. Our debit to AR is for the full $330. And then we have our actual customer payment. We can see the customer only paid an installment of $100 plus proportional tax of $10 out of that $330 invoice. We can also see our conditional sales tax then calculated proportionally to be 10 and moved from that settlement account to the Chicago City Tax Payable account. And we'll quickly take a look at reporting. This blank report is our sales tax payment report. It's going to be really helpful to understand how conditional sales tax works. If we were to run the report at the time of invoicing against the actual reporting tax code, the report would be and should be blank, which is how I ran it and how we can see it showed up on the slide. So why is it blank? As we discussed, invoicing doesn't impose any obligation on actual sales tax liability for conditional sales tax. Rather, the liability is held at the time of the payment, right? Our key feature of conditional sales tax. If I ran the report right after invoicing the customer, it will be blank. But if we were to execute this report against the conditional sales tax code, then it will reflect the sales tax balance for the quarter. So theoretically, if we did that, we would see my conditional sales tax code. I think it was conditional underscore IL. And we would see $30 in the sales tax amount for whatever period we ran it for. This is just to stress that invoicing does not impose any obligation on actual sales tax liability with these conditional sales tax agreements. When the invoice is posted, the transaction must be reported on the sales tax book report. However, it should be excluded from the sales tax payment report if everything's set up correctly. And I also wanted to review other sales tax reports offered in D365. These reports help businesses manage and analyze their tax obligations, and they're important for SOX. So just a quick summary of a few. We'll start with the sales tax transaction report. So this provides details on all sales tax transactions, including amounts collected and owed. So that facilitates accurate reporting. Next, we have the sales tax by customer report. There's also a sales tax by vendor report too, just note that. And this is going to provide an overview of sales tax amounts collected from customers over a specified period of time. So this report's crucial for businesses to analyze their tax obligations associated with their customer transactions. And then we have the sales tax payments report. This allows users to review and manage sales tax payments made to tax authorities. And then last but not least, we have the sales tax specification by ledger transaction. So this report is good to act as a sales tax audit report. It provides a detailed view of sales tax amounts associated with individual ledger transactions. This report is essential for businesses to ensure compliance and accurate reporting of their sales tax. In general, these reports enhance visibility into sales tax management, and they all can be found in the tax module of D365 under sales tax reports. Okay. In summary, we define what conditional sales tax is, and we reviewed the key elements of conditional sales tax agreements. We then reviewed the benefits and challenges of conditional sales tax agreements. So we specifically looked at the benefits between the parties of the agreements, so our buyer and our seller. And then we looked at the benefits of using conditional sales tax agreements over other financial methods, such as loans, leases, and hire agreements. We then reviewed the business purpose, where it fits in the overall process, who our typical users are, and we reviewed SOX compliance. And then lastly, we looked at numerous screenshots of the setups to configure conditional sales tax in D365. And we looked at a very brief demo of it in action. Once posting a customer payment, the sales tax will get calculated and moved from that settlement account to the payable account. Hopefully you guys have a clear understanding of how it works in D365 now.
Thank you for taking the time to dive into conditional sales tax with us today. We've covered a lot, so let's quickly recap the key takeaways. Conditional sales tax is a tax structure where sales tax is paid proportionally as payments are made, rather than at the time of invoicing. This approach provides greater flexibility for buyers while ensuring sellers maintain a security interest in the goods until full payment is received. We explored real-world use cases, such as automobiles, real estate, and equipment purchases, where conditional sales tax agreements provide financial flexibility and security for both buyers and sellers. We also compared it to other financial methods like loans, leases, and hire agreements, highlighting why many organizations prefer conditional sales tax for asset acquisition. From an implementation perspective, we walked through the necessary setups in D365, including tax codes, posting groups, and sales tax groups. We also saw how transactions are recorded in the system and how reporting tools help ensure compliance, including SOX-related considerations. If your organization is looking to better understand or implement conditional sales tax in D365, Logan Consulting is here to help. Whether it's configuring the system, ensuring compliance, or optimizing tax reporting, our team has the expertise to support you. For more information or to discuss how we can assist, please reach out to us at Logan Consulting. We'd be happy to help you execute this effectively in your organization. Thank you.